Today's episode is all about diversification. Can you build a property portfolio in a single city? And if so, how is it done? We hope you enjoy this episode and take away some hints and tips.
Welcome to the Brisbane Property Podcast with your hosts Melinda and Scott Jennison.
Hi everyone, and welcome back to another episode of the Brisbane Property Podcast with Scott and Melinda. And today we're going to talk a bit more about diversification in property.
Yes, welcome back, everybody. It's great to have you back on the Brisbane Property Podcast show. As Scott has pointed out, diversification is something that's often discussed in property investment, in the property investment world as a whole. And what we're going to unpack today is, can you diversify a property portfolio within a single city? And this is an interesting concept because for most people out there, you would probably think of diversification, the easiest way to diversify a portfolio is through location. But we're going to talk about different ways that diversification can apply within a property investment portfolio. So if you are looking to, ensure that you're mitigating risk and diversifying a portfolio, this episode's going to pack some value for you.
Yeah, it's always interesting when we get inquiries, when you hear people talking about, I want to buy 10 properties and I need that many properties in my portfolio and things like that. And then they say, I've bought a couple here. Now I want to go and buy in, I don't know, Darwin, Perth, Sydney, Melbourne, wherever it may be, for diversification. So we did really want to dig deep into this to help people understand some ways of doing it. So it's a bit of a summary. What is diversification?
Yeah, that's a good question. So diversification simply means mitigating risk. So it's ensuring that what you invest in has been spread out across different asset types or different locations or different areas, different income requirements to ensure that you are minimizing any potential risk associated with holding all of those assets within a portfolio long term. Now, a lot of people probably think of diversification within a shares portfolio where you don't want to invest all of your money into one company. So, the more the higher the volume of companies that you own in terms of the share portfolio and across different market segments in terms of different types of companies, that's going to minimize your risk by ensuring the portfolio is spread throughout different types of assets. The same can apply in property, and that's what we're going to discuss today. So it really is a way to mitigate your risk to ensure that you are investing the money that you've put aside for that asset class in a way that's going to get you access to reasonable returns over the long term.
Now you mentioned different types, and we'll dive into this a little bit deeper as we get moving forward. But obviously there's different types of properties, as Melinda mentioned, that you can look to diversify into. So I guess then it comes down to, if you look at it from the start, can it be done in a single city?
Look, absolutely. There's different ways to diversify a portfolio, and that's what we're really going to uncover today. Of course, within a single city, what you're not going to get is diversification across different states, and obviously that can bring an element of risk into play. We all know, especially if you've listened to the Brisbane Property Podcast as a regular listener, that property across all of Australia does not move in the same way at the same time at a nationwide level. So by not spreading your property investment portfolio across multiple states or multiple locations, you really need to understand a local market in a lot more detail. What we know, for example, if we look at the last 12 months, is that there's three cities that have continued to perform very strongly, and that's Brisbane, Perth, and Adelaide, whereas there are other capital city markets that have not performed as strongly. So if, for example, you had all of your money invested in, let's just pick Darwin, the Darwin market over the last 12 months has not really performed at all. It's been a stagnant market in terms of capital growth. Whereas if you had all of your money invested in a market like Brisbane, the Brisbane market has shifted in excess of 15% over the same period of time. So obviously, if you had all of your money invested in a single city such as Darwin, you may have missed the regional variation that can occur by investing in different markets in different areas. Now, that said, you're probably wondering why I'm saying, well, you can still get a diversified portfolio in one city. If you're a regular listener to the podcast, once again, you will know we often talk about the fact that the Brisbane property market is also not a single property market. And we can really break down in our city itself, especially when we're talking about Greater Brisbane, so many sub-markets which are performing in a different way at a different time. So this is why, we can never assume that one capital city market or regional market is a single market in itself. And it's always important to understand and break down what's actually happening in different parts of that market. And even you can get location diversification within a single capital city to some extent. Now, the big things that are not going to or that will impact you if you're not looking across multiple states are things like the local economy. The local economy typically will impact a capital city market in a similar way. Population growth into a region will also have an impact on a capital city market. So it's more of the local drivers of supply and demand that can influence what's happening at a local level in a market. And that's where intricate knowledge of that local market becomes really important if you're not going to invest through different locations throughout the country.
So obviously the risk appetite side of it is going to be, that's the individuals and their risk appetite. And it's also your comfort levels. So, that's where you need to understand, are you comfortable buying in another state, in another city, when you probably don't know that location at all? We are comfortable in Brisbane. So from our own point of view, when we look at our portfolio, for example, we're comfortable in Brisbane and we're very happy to have our property portfolio set up in Brisbane. And that, for us, that works for us.
Yeah, that's right. Now, obviously, sharing some secrets there, there's different ways to invest within a single capital city market, as we have personally done. Now, if we can run through some of those different scenarios, of course, most people listening to this podcast will know that Scott is a licensed builder. So, a very sophisticated way to invest in property is to manufacture equity through renovation, through redevelopment, and through adding value to property. You cannot change the location, but you can change the property. And that's a skill set that not everybody will have, but it is a way that you can provide, a different type of strategy within your portfolio within a single city. Now, most people will typically look at investing in residential property when they're starting out on their investment journey. And we're going to talk about the different types of residential property as we move through this podcast as well. But there are also other asset types within property as an asset class. For example, you can invest in commercial property, which might be an office space. You can also invest in industrial property, which might consist of a warehouse or a factory. You can invest in multi-use facilities, which might be a combined use of some commercial and some residential. So you can see even within a single location, you can get diversification within a property portfolio by asset type. And that's something that we're going to really break down and talk about in detail today.
Now, we're not always comfortable talking about our own story or our own investment side of it, but as Melinda said, we will touch on some of that and some of the things that we go through in the different types of property assets and things like that. We can personally say we're involved in a lot of these, which is why we're going to share that sort of information today. Not all of them, but quite a few, and it just gives you an idea of that difference and the diversification that you can actually get in the one city. So I guess when we start to look at the start of it, the best thing to do, I think, from people at the beginning, if this is something you're looking at, is your team. So how can it be done?
Look, I think that it's absolutely critical that if you're investing within a single state or within a single city, that you do work very closely in conjunction with your accountant. The reason I say that is because obviously every state has its own threshold for land tax. Land tax is something that you will be charged as a property owner when you're combined value of land value, that is, exceeds a certain limit. So if you're purchasing property in your own name as an individual, you will have a land tax threshold here in Queensland of $600,000. If you're purchasing property with a partner or your husband or your wife, you'll have a $600,000 threshold per person. So that will give a total aggregate threshold of $1,200. Now, of course, it's not going to take long before you start to exceed those thresholds, and then land tax will be applicable. And this is why it's important to work in close conjunction with a property savvy accountant, because there are other ways to structure a purchase when it comes to building out a portfolio in a single location. And that may be through the use of trusts or companies, or even self-managed superannuation funds. Now, the purpose of this podcast is not to give any advice in terms of the structure. Of course, seek independent advice in that regard. But if you're not already working in conjunction with a property savvy accountant, I would suggest that you seek the services of one, because they will really help you to build out your portfolio in the most tax effective way. And they'll provide advice for you that will consider the land tax thresholds, as well as the type of asset that you're looking to buy, what the cash flow position on that asset is likely to be, how long you intend to hold that asset, and what the exit strategy for that particular asset might also be. So I would say that an accountant becomes a pivotal person within the team first up.
Yep, definitely.
Also, I would say that you need to work in close proximity with a mortgage broker who is not only able to just or not only has experience in funding in single names, but also in entities as well, because you will then find that your lending structure can become a lot more complex if you are building out a portfolio within different structures. So again, working with a mortgage broker who's experienced in that type of lending, because especially when it comes to, for example, self-managed superannuation funding lending, it is a specialised area. So again, seeking out someone that has worked in that space will work to your advantage. Always, I would say, working with a qualified property investment advisor who is accredited with the Property Investment Professionals of Australia will ensure that you're going to get a really holistic view on the best way to build out a portfolio, considering the various phases of investment strategy.
And obviously solicitor. So there's a whole team that you need to build around, and that the better the team and the more organised things are at the beginning, the more successful this can actually be, and less stressful as well. I think when people start to look at building a portfolio, there's different phases, like when to buy, what to buy, and different types of assets. This is where, as Melinda mentioned earlier, just a second ago, about the qualified property investment advisor side of things, this is where you need that advice, and this is where it'll help you talk through the different phases. Now, I'll let you explain that a little bit more when I'm talking about these phases that you talk about buying properties and going through life.
Yeah, it's really important that people understand that when building out an investment portfolio, it may be that you're looking at different types of properties at different phases, depending on what you're trying to achieve and depending on where you are in your property investment journey. So the three phases of building out an investment portfolio are the accumulation phase, followed by the consolidation phase, and then you move into an income or retirement phase. Now, here with our team at Streamline Property Buyers, one of our qualified property investment advisors will always sit down with every property investor to provide a strategy session. And in that time, we're really trying to determine where an investor sits in terms of that journey. Which phase are they looking or are they positioning themselves in? And that's variable depending on their life circumstances. It depends on, how old they are potentially, what their current income levels are, whether they own any other properties within their portfolio, and the equity position at a portfolio level. It also, we would also consider their risk appetite in that session to determine what is it that is going to align with their goals that also is going to fit in with their risk appetite. Now, I would say that the majority of people that are in accumulation phase, which is the starting phase of building out an investment portfolio, would be looking at residential property as the first type of asset that they would be adding into their portfolio. Now, traditionally here in Brisbane, I would say that the majority of people that look to invest in Brisbane property, especially historically speaking, they would be targeting a house on a single lot. Now, obviously, that's one type of residential property that exists here in Brisbane. Now, if you've listened to some of our recent podcast episodes, you will have also heard that the unit market in Brisbane, especially in the last 12 months, has surpassed performance compared to the housing market, which is quite unusual. And we've seen this strength in the unit market now for the last couple of years across the city. And because of that, we also must consider, whether a unit on its own, a unit as a separate asset type might be suitable for an investor, depending on where they are in the journey. And obviously, buying a unit or a house is quite a different type of property. And then there's a townhouse, which also sits somewhere between a unit and a house. So you can see even within residential property, there's different asset types that you can consider. And the consideration as to which might be more suitable for an investor at a particular point in time would very much depend on where they are in their investment journey. It may also depend on whether or not they have a certain yield requirement, that is an amount of income that they need that asset to generate on a monthly basis, especially if that is to satisfy a funding requirement. And it may also depend on affordability, what their budget will buy. So all of these things, as you can see, need to be considered in that accumulation phase when people may be considering adding a residential property into their portfolio.
So when you talk about the yield, then I guess there's other types of assets then that come into the residential. So there's other things like you talked about units, townhouses, you mentioned houses. There's also then things like rooming accommodation, dual locks, those types of things, which will fall under that residential side.
That's right. And of course, when you move away from purchasing a single dwelling or a unit or a townhouse that you're going to rent out to the private rental market, and you're moving into some of these strategies whereby you are really looking to generate a higher income from the asset. And Scott's pointed out a few of those, whether that's a rooming accommodation arrangement or a dual occupancy arrangement, even a house that might have the ability to add a granny flat or a house with a granny flat already in place. Not a hugely popular strategy here in Brisbane, but certainly in some of the greater Brisbane council regions, it is something that is more common than it is in the Brisbane City Council region. I would even say short-term accommodation letting on things like Airbnb. These are all strategies that some investors choose to dip their toes into simply to increase the income that the property may generate for them whilst they hold that property long-term. Investors must always remember that to minimise their risk or downside risk on the sell, if they're targeting a property that appeals to the majority of the market, they're going to have a quicker exit. And what I mean by that is any properties that a home buyer would typically be attracted to, because home buyers make up the largest majority of buyers, between 65 and 70% of all buyers in a market at any particular time are home buyers. If your property appeals to that segment of the market, it's likely that the sale will be lower risk. If your property does not appeal to home buyers, then there's going to potentially be a longer sales period or a more discerning buyer that you're targeting when it comes time to sell. So the exit strategy is always something that you must consider when you're looking at diversifying into different types of income producing residential property types, because someone that's looking to buy a rooming accommodation property or a dual occupancy property or a house with a granny flat, you're going to have a much smaller market segment that would be looking to purchase that in the future.
So from residential, there's obviously then the commercial industrial side of things. So that's when we're talking about offices, for example, retail, and then industrial, you've got your warehouses and your factories as well. So another type of investment when it comes to diversification.
It certainly is. And, a lot of people might consider diversifying into commercial or industrial property as they move into that consolidation phase within their portfolio. Quite simply, when we're looking historically at the data, residential property has shown consistently higher capital growth compared to commercial property, whereas commercial property typically shows higher yields. That means higher incomes. So those that are looking to increase the cash flow in the portfolio, when this usually occurs around the consolidation phase, at that time, some people may consider commercial or industrial property. Now, the big difference between the two really is in the holding costs and the income. So if we were to consider residential property, for example, when you own residential property as a property investor, all of the costs associated with that property are borne by the landlord. So yes, you do have to pay interest on the mortgage. You also have to pay the rates. You have to pay for the water bill. You'll also have to pay for insurance on the property and property management fees as well. So all of those costs come back into reducing your net return. So whilst in Brisbane, you might have gross yields sitting anywhere between 3 and 5% in the residential space for standard residential properties, sometimes a little bit more if you're looking for a unit. Once you take out those expenses, that net yield can drop down below 3%. So obviously, it's not a great cash flow proposition when you're considering all of the expenses associated with holding that asset. Whereas with commercial property, in the large majority of cases, it is the tenant who will pay the outgoings when you enter a commercial lease. So for a landlord who owns a property, they will have to pay the interest on the mortgage, but a lot of the other outgoings associated with holding that asset are actually paid for by the tenant. Generally, also with residential property, your tenancy agreements are no more than 12, sometimes 24 months, but 12 months is the norm. Whereas with commercial property, it's not unusual to have much longer terms or timeframes associated with those commercial leases. So it provides more certain income whilst those tenancies are in place. But obviously it does come with more risk as well, because it's much harder to find a commercial tenant in some markets than it is to find someone that needs a home. So all of these risks must be weighed up in order to assess what type of asset is right for you at a particular point in time.
I think that risk appetite's really important there. And as we touch on, when you've got a residential house or unit, for example, you're looking for a tenant that's probably 12 months, and generally they will come around a lot quicker. When you're in that industrial commercial space, probably the minimum side of things there is about a 3-year with a 3-year option. Some of them go to 5 or 10 years. Again, you're looking for someone that's going to commit to something for a long period of time. So you could find if someone moves out, for example, you could have a long period of time when you've got holding costs and you've got no income coming in. So that's a risk that people need to understand. There's different things, obviously, when it comes to residential. You have an entry condition report with a house or a unit, residential side of things. It needs to be left in the same state that it was. Other things like industrial warehouses and office spaces, generally you need to go in and you replace the carpet and you paint it all and things like that. So there's so many different factors that you need to understand with those two different types of investments.
Yeah, so obviously we've now talked about the different types of residential property that people can invest in within a single city, that being a house, townhouse or unit, or alternatively other higher cash flow producing residential properties such as share houses, dual occupancies or houses with granny flats, or even units, houses or townhouses that are let out on the short-term letting market on platforms like Airbnb. And of course, there's pros and cons associated with that approach for anybody that owns residential property as well. And then we've talked about commercial property or industrial property, or in fact, mixed use property. A lot of the time people will add that into their portfolio as they're approaching that consolidation phase or moving towards that income phase. When they're looking to generate more cash flow into the portfolio, they're less focused on the long-term growth. Perhaps they're more experienced investors. They've already got a strong equity position from other residential properties within their portfolio, and they're really looking to boost some cash and even out that portfolio. So you can see at a portfolio level, it makes sense to get a balance of not just capital growth assets, but potentially income producing assets as you're approaching that retirement age, so that you can, generate the income that you're wanting to support the retirement that you're looking for.
So it's all about that planning, and we talk about things like exit strategies as well. And that doesn't have to be selling the property, but it's changing and moving, as you said, the consolidations phase and all those types of things. The other one, which we did touch on very briefly, is that value add through buying properties that need renovations or redevelopments. So you could buy, for example, a property that you can sit and hold land bank for a while, rent it out for a period of time, and then if it has the opportunity to be either renovated or demolish it and build brand new. So there's another way, obviously, then of diversification, a bit more sophisticated when it comes to that, and a little bit more knowledge, I guess, in the building side of it, or you need help on that type of thing, obviously, to go through the development side of it.
Yeah, I must admit the renovation or redevelopment process is a lot more difficult if you're not local to oversee it, unless you're paying for a development manager to look after that process on your behalf. Obviously, if you are located in a particular city and you're performing your own renovations or supervising your own redevelopments, it's a lot easier to do that nearby than it is to do that remotely. And so that's why we see a lot of people that set up very successful businesses in continuing to renovate or redevelop properties within a single city. Now, for some people, that's actually a business, not necessarily an investment strategy, but for other people, they set it up as a very successful investment strategy, whereby they're performing the renovation. Instead of selling upon completion, they're actually refinancing, pulling that equity out and using that equity as the deposit for the next project that they go to work on. And we've seen that successfully implemented for many people over the years. And it's certainly a great strategy, depending on your personal circumstances and your risk appetite. We generally see at some point in that development pipeline, there will become a point where you may need to offload some of those items that you're renovating or redeveloping to continue to have the cash flow to move forward on second and subsequent projects. So again, it all comes down to your individual circumstances. Everybody's starting their property investment journey from a different baseline. Everybody has a different income, a different tax bracket, and most importantly, everybody has a different risk appetite. I would say the majority of people that we speak to who are looking to build out an investment portfolio have different goals. They've got different targets that they're looking to achieve, and they've got different time frames. So people might be starting when they're in their early 20s. Other people we work with might be starting in their mid 40s or even into their 50s. And the types of properties that we may be recommending for people at different points in their journey may vary depending on their personal circumstances. And that's why it's important to seek out professional, independent advice based on your personal circumstances.
So diversification in a single city, can it be done?
Well, I believe it can be done. It can be done very successfully, providing you've got the knowledge of the local market in order to minimise your risk and still ensure that you are spreading, the investment dollar through a number of different mediums within that single city. And I think, evidence, we practice what we preach. We're not invested outside of Brisbane ourselves, but we definitely have built out our own portfolio across the city through a number of these asset types that we have discussed. And I think that it's been a successful strategy for us. And that's why we wanted to share that journey and the fact that it is possible for those that are looking to follow a similar journey.
Yeah, I agree. I knew what the answer was going to be when I said that question. But yes, it can be done, and it can be done very well. And I personally, I think Brisbane's a great spot to do it in as well. That's not being biased either. We love Brisbane, as we always say that. 3 quick takeaways from the podcast.
Look, first of all, I would say that you don't have to focus purely on location diversification to set up an investment portfolio that is going to minimise your risk long term. It does come down to understanding a local market and looking at other ways to diversify the portfolio.
And different asset types?
Yeah, second takeaway is that there's a number of different asset types, even within property, that you can look to provide that diversification. And we've talked about that. Lots of different types of residential property, commercial property, industrial property, mixed use property. And you can get diversification through those different mediums. Final takeaway, I think it's the most important takeaway. If you are looking to build out an investment portfolio within a single state or a single city, you must work with a professional team of advisors around you so that you don't make mistakes. And in fact, that advice I would extend to anyone looking to build out a portfolio, even at a national level. I think getting expert advice along the way will really fast track that journey to success. And it will just avoid you making those mistakes that a lot of people do make on their journey.
Yeah, it's a costly mistake sometimes if you do make those mistakes. That one's huge for me, building a team around you. And if people are unsure, and if we've given away a lot of information today, and if you're not sure and you're thinking, I don't have an accountant or I don't have a mortgage broker, things like that, we do have contacts, so we can put people in contact with these type of people. And it just makes life easier for everyone. It avoids those big mistakes that people can make when it comes to investing into property, especially when you're looking to build a property portfolio and diversification, which we've covered a lot today. So look, hopefully that's been great information. Again, as I normally do, I let Melinda wrap it up. And from me, we'll talk again soon. Thanks very much for listening, and bye for now.
Yes, thanks once again for tuning in to the Brisbane Property Podcast. We hope you've found this episode enjoyable and the content, as usual, informative. If you have enjoyed our content, please leave us a review, share this episode with friends and family, and let others know about the information that can benefit them as well. As always, we hope you have a fabulous week, and we look forward to speaking with you again soon. Bye for now.